Time for today's three-stock lunch. We have some blue chip names all under pressure as the market sees big losses. First up, shares of Bank of America. They are lower despite announcing plans to hike its dividend by 2 cents. Let's trade that name and more with Victoria Greene, founding partner, chief investment officer at G Squared Private Wealth. She's also a CNBC contributor. Let's turn first to Bank of America, which is down 15% year to date. Is it a bargain or something to continue to stay away from?
I'm not buying them yet. I think they are a quality company. My concern is just they had set out a target for net interest income growth of 8%, and it might be a little bit harder to meet because I heard it described very well that the raw materials for banks are their deposits, and their raw material costs are climbing tremendously as they've had to actually start paying on their deposits. Long gone are the days that they can hold on to everything paying, 0.1% interest on their savings account. People are moving their deposits faster, so there's a rising cost to deposits, and you might see some loan growth slowing. So I think that net interest income growth of 8% target might be a little high. So right now, I'm just not buying Bank of America. Sit on the sidelines, and it's not something I think we need to be kind of bottom feeding for today.
Victoria, American Express is down by nearly 4% after a downgrade from Baird from outperform to neutral. The firm says the risk reward is no longer attractive, but it's up 15% year to date. Would you get in?
Yeah, and I actually am a buyer here of American Express. It's one of my favorite picks in the credit card space. I think they just have a more loyal customer base, and they're not just credit cards. They have a huge following in the small business lending and the small business card. So it's not just high net worth individuals. They've expanded in. They're capturing the millennial market. They have a lot to love in the travel market, and travel is still booming. So I see them being able to grow, and they're on pace. They're 11.40 EPS for 2023, and I see them being able to achieve their targets. I'm not as concerned. Their net charge-offs and their delinquency rates are still well below pre-pandemic levels, whereas their loan growth and their lending and credit card balances are above it. So I think all of those things are a positive sign of the health of this very well-run company. And so Amex to me is a buy in the dip.
And finally, let's turn to ExxonMobil slipping after signaling that second quarter earnings will be hurt by lower natural gas prices. Where do you stand on Exxon?
Yeah. And refining margins. It's $2.1 billion hit on refining margins, not just lower natural gas. So for me, Exxon's a sell just because this market is tightening and they cannot get out of this commodity downturn. No matter how hard Exxon tries, those record profits that I saw a year to 2 years ago, especially the refining profits, were record levels. Just hard to hold on to it. It's likely we see more earnings revisions in the second half just because they cannot continue to produce at record levels when you can't get WTI to stay above 70. And yes, natural gas prices have improved, but it's improved from like dismal to slightly terrible. It's not like nat gas prices are on fire right now. So I think they're just facing an uphill battle to grow their profits. They are still going to be able to cover their dividend. They're still going to be able to do share buybacks, but it's not like they're going to see these record growths they saw the last 2 years. So I'm worried the stock's not going to be able to hold on to 100. It might slip below it.
Victoria, we're seeing the broader markets down today in reaction to the data we got earlier. Where do you think we go from here?
I think you do get a little bit of a suck back, even though July is historically a strong technical month. I look at this market and say it's just ripe for a pullback. We'll see as we get into earnings, but expectations are not rock bottom anymore. It's going to be a little bit harder for companies to beat these hurdles. You have a Fed that is determined to raise rates again, another 50 basis points. They're not accommodative yet at this time. We're still seeing liquidity sucked out. The banks, if they show slowing loan growth, that's more and more liquidity that's not available to the average customer that's trying to, repair their home. And the one thing I want to point out, today's numbers again came from private payrolls. This is not the same data we've seen the households report. The household unemployment number is the one we've seen going up. So we have this dispersion in employment data of how healthy is it really? It depends if you're talking to the households and the individual or the companies who are claiming we're growing payrolls at a record level almost.
Victoria Greene, appreciate so much you joining us. Thank you.